A lot of buyers shopping above the conforming loan limit assume the process is basically the same as a conventional loan, just with a bigger number. What do they not know?
What they don't know is that this is a completely different underwriting conversation. The product looks similar from the outside, but the qualification process is not. They require more reserves, stronger credit, more detailed documentation, sometimes a second appraisal. You see, the bar moves, and buyers who don't know that often get surprised deep in the transaction.
Start from the beginning. What is the conforming loan limit and why does it matter?
The conforming loan limit is the maximum loan amount that Fannie Mae and Freddie Mac will purchase from lenders. In most of the country in 2026, that limit is $832,750 for a single-family home. In high-cost areas such as parts of Colorado, California, New York, it can be higher. See, below that limit, you're in conventional financing territory. The guidelines are standardized, the rates are generally lower, and lenders have significant competition for your business. Above that limit, you're in jumbo territory, and lenders are holding these loans on their books or selling them to private investors rather than government-sponsored agencies. That changes the risk calculus, and it changes what they require from borrowers. In the Colorado market specifically, a meaningful percentage of move-up buyers are now shopping in jumbo territory, whether they realize it or not. Denver Metro, mountain markets, Front Range, purchase prices above $800,000 are common, and those buyers need to understand what they're walking into.
What's the biggest misconception about jumbo loans?
One of the biggest misconceptions of jumbo loans is that the rate is dramatically higher than a conventional loan. It can be, but the spread has narrowed significantly in recent years, and for the strongest borrowers, jumbo rates are sometimes competitive with or even slightly below conventional rates. Here's why. Lenders want high net worth, high credit borrowers on their books. A jumbo borrower with a great credit score of 780, 18 months reserves, and a strong income is an attractive asset for a lender's portfolio. That competition drives rates down for qualified borrowers. The rate premium for jumbo is real, but it's not a flat tax. You see, it really depends on your credit score, your loan-to-value ratio, your reserves, and which lender you're working with. A buyer who shops only one lender for a jumbo loan is likely leaving money on the table. The myth that jumbo is automatically expensive leads buyers to avoid properties they could actually afford or to not shop aggressively enough on the rate.
Walk us through how the underwriting actually changes above the conforming limit.
Well, there's 4 areas where jumbo underwriting is meaningfully more rigorous than conventional. The first one is reserves. A conventional loan might require 2 to 3 months mortgage payments and reserves after closing, sometimes none. On a jumbo loan, 12 months is common. On loans above $2 million, some lenders want 18 to 24 months. That's liquid assets, not retirement accounts, not equity in other properties, cash and brokerage accounts that can be converted quickly. Number 2 is credit score. The floor for conventional financing can go into the 600s depending upon the program. Most jumbo lenders want a minimum score of 700 to 720, and the best rates are reserved for borrowers at 740 and above. The third one is documentation. Self-employed borrowers, business owners, and anyone with complex income documentation will find jumbo underwriting particularly thorough. 2 years of tax returns is standard, business bank statements, CPA letters. The underwriter's doing a detailed income analysis, not just running a number through an automated system. And number 4 is appraisal. Loan amounts above $2 million typically require 2 appraisals, not 1. That adds time and cost to the transaction, and it adds a step that can complicate offers in competitive markets. None of these are reasons not to do a jumbo loan, they're reasons to prepare for it correctly.
Tell me about a jumbo buyer situation that didn't go as expected.
Okay, so we had an executive relocating to Colorado. Strong income, good credit, 740 FICO, had bought homes before with conventional financing and assumed the jumbo process would be similar. Purchase price was $1.4 million. The income side qualified without issues, but where we ran into complication was reserves. He has significant assets, equity in his previous home, retirement accounts, and brokerage accounts, but in terms of liquid assets available immediately after closing, he was closer to 6 months reserves than 12. The lender we initially submitted to required 12 months liquid on the loan of that size, so we had to restructure. We shopped the loan to a second lender simultaneously, one whose reserve calculation counted 70% of his vested retirement balance towards the requirement, instead of excluding it all the way like the first lender did. That alone closed the gap. He didn't have to touch his brokerage holdings, we funded, but it took an additional week because that reserve conversation didn't happen until after he was already under contract, not before. If we'd had that reserve conversation before he made the offer, instead of after he was already under contract, none of the scrambling would have happened.
What do jumbo buyers need to know that they usually don't find out until it's too late?
Well, there's 3 things that consistently surprise buyers in jumbo space. First, condo and co-op restrictions. Jumbo lenders can be significantly more restrictive about property types than conventional lenders. A non-warrantable condo, one that doesn't meet certain ownership concentration or financial requirements, may not qualify for jumbo financing at all, or may qualify only at a significant rate premium. If you're buying a condo above the conforming limit, check the building warrantability status before you fall in love with the unit. Second, the self-employed income calculation. A W-2 borrower's income is straightforward to document. A self-employed borrower's income on a jumbo loan gets analyzed in detail, not just the net income from tax returns, but the stability of the business, the trend year over year, and sometimes the business's balance sheets. Buyers who have structured their finances to minimize taxable income sometimes discover that the jumbo underwriter sees a lower qualifying income than they expected. And then the third is rate shopping matters more on a jumbo. You see, a quarter-point difference on a rate on a $1.5 million loan is not a small number over time. Different lenders have different appetites for different borrower profiles. A lender who's aggressive on a 740 credit score borrower may not be the best option for one at 760. Shopping the rate takes time, so build it into your timeline before you're under contract.
What's the most costly mistake jumbo buyers make?
One of the more costly mistakes they can make is going to their primary bank first and assuming it's the best option. Most people have their checking and savings at a large bank. They have a relationship there, and they assume that that relationship translates into better pricing on a jumbo loan. Sometimes it does, but often it doesn't. Large banks have jumbo programs, but they're not always the most competitive option for every borrower profile. Smaller portfolio lenders, mortgage banks, and specialty jumbo lenders often have more aggressive pricing for specific credit and income profiles. And because jumbo loans aren't standardized the way conventional loans are, the variation between lenders can be significant. The single most valuable thing a jumbo buyer can do is get pre-qualified with 2 or 3 lenders before they're under contract. Not play them against each other after the fact, but to generally understand which lenders' programs fit their profile best.
For a buyer shopping above the conforming limit right now, what do they need to do?
First, before you tour a single property above $1 million, have a detailed pre-qualification conversation with a lender who does jumbo loans at volume. Not a pre-approval letter, just a conversation. You need to understand your reserve position, your income documentation picture, and which property types will qualify. That's a 30-minute call that saves weeks of stress later. Second, get a realistic sense of your liquid reserves right now, not total assets, liquid assets available within 30 days. That number determines which programs you qualify for and what terms. Third, if you're self-employed, pull your last 2 years' tax returns and look at your net income number. That's likely the starting point for what a jumbo underwriter will use. If there's a gap between that number and your actual cash flow, we need to talk about how to document the difference.
Where do they find you?
Well, you can schedule a call with me at teamaronheim.com. If you're shopping above the conforming limit, or you think you might be, let's just have a 30-minute conversation before you're under contract. I'll tell you exactly where you stand on reserves, credit, documentation before any of it becomes urgent. Or text me at 720-248-6892. Jumbo buyers who prepare correctly close without surprises. The ones who don't have very stressful final 2 weeks. Let's make sure you're in the first group.